So I think the skill sets of an early stage venture investor versus a growth versus a buyout investor are all quite different in terms of the value add. And I say that because if you think about, if you're a buyout person, one of your core competencies is access to capital markets, debt capital, and public equities or other forms of capital, get your cost of capital down. Not so much a skill set that's really requisite for us or for venture. On the other hand, if you're a venture person, particularly earlier stage, you're thinking about working very closely with the management teams. You haven't entirely, identified perhaps what the core business fundamentals are quite yet. So maybe you're going to make a pivot. Pivot to us is not a good word. Pivot. If our companies are pivoting, that's not a good thing. Certainly if a buyout-based, oriented company is pivoting, that's a bad thing. But we are in the growth world. We're very focused on things like corporate governance, filling out the rest of the board, forming subcommittees. So you'll find all of our companies will have typically an audit committee and a comp committee, which 9 times out of 10 hasn't yet been formed at the point of our investment. We will also be pretty heavy in terms of helping the company in terms of their strategic thinking, in terms of filling out the balance of the management team, but not the whole management team, because at the point of our investment, most of the team has been formed. So it's similar kind of stuff. It's just different stuff.
Right. And, thinking a little bit about the work you do, the due diligence, to get comfortable with deals, folks who look at public companies are, often thinking about, public information and kind of earnings reports and, this package that you get that's very standardized.